One of the things that's really important for all of us to do is to have a financial checklist that we look at least once a year. So whether you're 30, 40, or 50, your future self, when you retire, is going to be very thankful that you spent the time to do this checklist. Let me give you an example of one of the main things that I think is super important, and that is to make sure that your money is in what I call one of three different buckets, and you have some money in each of these buckets. And the reason this is important is you do not want to get in a situation where you're retired and every dollar that you take out of your account is going to be taxable, is going to be ordinary income. I have a friend once that joked with me. Unfortunately, he did not do this earlier. And when he retired, he says, every time I buy a loaf of bread, I have to pay income tax on it. You don't want to be in that situation. So the three buckets are high level is a tax me now, but never tax me again bucket. And that's your Roth IRAs, your Roth 401ks. The next bucket is a don't tax me now, but tax me later bucket. And that's really what a regular IRA and a regular 401k is. You get the tax break day one, but as you take money out later, you get taxed on it. That's what my buddy had most of his money in. And then there's the money in your bank account, which is in the tax me as I go. So item number one in the checklist is to make sure that you have money in all three of these buckets so that you can control your tax rate. And you know what? If you're 50, you still have time. If you're 60, even, where you really get hurt is when you're taking out required minimum distributions in your 70s. So even if you're 60, you still have time to adjust. But if you're 30 years old and saving money, thinking about these three buckets is going to be super helpful. The next thing that I want you, let's go for a quick little walk as we talk about this. The next thing I want you to think about is your asset allocation. How much of your portfolio is going to be in stocks? How much is going to be in bonds? And the reality is 80-90% of your investment success is going to be based on that asset allocation. So it's really important you look at that once a year. As I record this, the stock market's near all-time highs. And if you're over allocated to the stock market, if in 2022 when the market was down, that felt painful to you, the time to adjust is now. You don't want to be a forced seller in a down market. And who knows, next month the market could start heading down. So I want you to look at it at least once a year, ask yourself, am I in the right asset allocation? If you're not, if you're overexposed to stocks, the time to make those changes is when the stock market's doing well. Okay, the third one. Hopefully most of you already have this in place, but check your emergency fund. Is it somewhere that's liquid? Can you get to that money relatively quickly? Is it in something like a bank CD or a regular bank money market account? Something that you don't have to worry about it fluctuating in price. And really, your emergency fund, the goal there is not to make money on your money. The goal of the emergency fund is to give you time and to give you optionality. So when you're younger and you're still working, the idea is, God forbid, if you were to lose your job, if you have an emergency fund that's 3, 4, 5 months worth of your living expenses, it gives you time, if you lose your job, to find the right job for you. And if you're retired, what an emergency fund does is it gives you time. If you find yourself, let's say there's an unexpected car expense or something happens to your house and maybe it costs $10,000. You know what? It's nice to be able to stick to your long-term plan and use that emergency fund to capitalize whatever that expense is, as opposed to selling something. Okay, so that's item number 3 in our checklist here. The next one, and these checklists don't always have to be at your end. You can do it anytime in the 12 months, but particularly in the first 3 months of a new year, look at how much you've put aside in your IRAs, whether that's a Roth IRA or a regular IRA. A lot of people think the deadline, for instance, for a 2023 IRA contribution is at the end of December 2023. But it's actually when you file your final tax return for the year, which for most of us is going to be in April of the following year. Now, a word of caution: if you have your money at a custodian like a Charles Schwab, a Fidelity, a Vanguard, or even at a bank with your IRA, make sure you tell them what year you want that IRA contribution to count towards. Because if it's 2024 and you go to the custodian and say, I want to put money in my IRA, the default is probably going to be for that calendar year. So if you want to make up for last year, maybe some money that you didn't put into your IRA, make sure you tell them and you have documentation that you still have put that money in for the previous calendar year. So again, that deadline is the final tax date of the final tax filing date of the next year. So that's another thing to think about. If you have a health savings account, which for people with a high deductible health care plan can put money aside, and that's really the ultimate savings tool, because you don't pay tax on the money that you put in. You get the tax deduction there. It grows tax-free, and you can take money out tax-free as well, as long as you have receipts for the medical expenses. So if you did not fully fund your health savings account, the HSA, you have until your final tax filing date for that as well. So that's another thing that you can think about as April approaches for most of us. Okay, the next one is your 401k match. If you work for a company that offers a 401k and your company does a match, that's the next place to kind of put your money, is up, at least up until the company match, which for a lot of us is maybe 2 or 3% of our salary. That is, there's not many guarantees in the stock market. And as a fee-only financial advisor for 20 years, I can share with you that's one of the few guaranteed 100% returns, is the money you put into your 401k that your company's going to give you a match on. Next one is credit cards. Look at your credit cards. If you're running a balance on your credit card, try to get that paid off. That's something worth looking at once a year. The next two are the ones that I think are most important, and that is your health. Let's look at your health. Let's look at the investment that you're making in staying healthy. Are you working out? Are you investing in your health? And if you're not, it's a great time to look at the coming 12 months and say, what are you going to do differently in the next 12 months to take advantage of that? And then the final one that I think all of us have to invest in, and it's one of those things that's super easy to take for granted, and that's investing in our relationships. Investing, if you're married, with your spouse, your life partner, and taking the time. If you have a great relationship, the idea is, what can you do to make it even better? And if that relationship's a little rocky, don't be afraid to invest in some marriage therapy, some marriage counseling. Full disclosure, I've been married 35 years, and occasionally my wife and I have gone to counseling, and I think it's a good thing to do that. You're not saying we don't have a good marriage. What you're saying when you go to counseling, and whether you're married or your life partner, you're saying, this relationship means a lot to me, and I want to keep it healthy. So those are the main items for your checklist. And I also want you to think about watching this video up here, where I talk about 5 reasons to retire as soon as you can. You're doing a lot of things right, and I want to see you actually take advantage of doing these things right and be able to enjoy your retirement. I'll see you in this video here. Thanks for watching this one. Bye-bye.